ladies and gentlemen. First of all, let me thank the SGX for working with us on organizing this event, and it's my great pleasure and privilege to welcome you all to this 2024 Singapore Iron Ore Forum. Singapore is, of course, the center for global iron ore trading, and of course the SGX have played an incredible part in making that happen. And we've been very fortunate to have partnered with the SGX to support the market over the last more than a decade. In fact, we began the work on seeing the evolution of this market back in 2006, so almost 18 years of hard work, and over that period seeing this market develop. And of course our role is to provide and develop the transparency for the market through the pricing we provide, but also that of course creates the opportunities for creating risk management products. And of course part of what we do also is communicating and bringing the market together, which is why this event is so important. Fastmarkets, in fact, of course, we've been actively involved in developing the indexes since 2006, but we've actually been pricing iron ore since back from 1913, when we were first originally launched. And it's interesting, when I have in my office, I still have large leather-bound volumes which shows all the printed invoices, when even the UK was an iron ore producer, showing the transactions that were taking place then. Of course, today, the world is going through another major transformation. That transformation is, of course, driven fundamentally, a lot of what's happening in the market today, by climate change. And that in itself is driving, in turn, innovation. It's driving the emergence of many new technologies that will help decarbonization. But alongside that, we're also seeing very rapidly shifting market dynamics, all of which are reshaping the landscape for iron ore as it stands today. So let me talk to you a little bit more about some of these market dynamics before we go into our first session for the morning. So firstly, this chart here, what this shows is crude steel production in China. And what it also shows you, of course, is how steel production has been in decline since 2019, something which probably we wouldn't have expected to see. But of course, there were many factors that led to this reversal. It's driven, of course, by the economic fundamentals that we see in the country. And the key driver for steel demand in China is, of course, the construction industry. That accounts for 1/3, just over a third, 35% of all China's steel demand. And of course, the real estate market has been very much in the doldrums, especially for the last 2 years. And when you combine this with financial uncertainty about the viability of some of the large property developers, we've seen some large developers going out of business, a run on some of these stocks. It's had a very negative impact on both the producer margins as well as steel demand, of course, driving it. And of course, steel demand is leading to lower prices, but you're also operating in an environment where we have higher raw material costs, and both of these things are combining to really hurt margins of Chinese steel producers, especially those in hot rolled coil. Despite this, there is some support for the market in China. We're seeing support from, of course, government initiatives, also through increased steel exports, but nevertheless, it won't really help reverse the trend. And in fact, for 2024, our expectation and our analysts are forecasting that Chinese steel production will fall below the 1 billion ton mark, which is the first time you'll see that level of production since 2018. What this chart shows is the trends in prices. It actually shows the Fastmarkets 62% Fe iron ore price index. And of course, it's clear, lots of volatility in the markets. You're seeing that big decline in prices due to COVID up until the end of 2022. And then, of course, the Chinese lifted their COVID restrictions. We saw an anticipation, sort of iron ore prices rise in anticipation of a big economic bounce that never materialized in China. And then from 2023 mid, we saw those prices back in decline. And then, of course, this year, we've seen economic stimulus measures supporting prices and boosting sentiment, prices rising, but really not getting past that very key $140 mark. Looking ahead, as I said, the outlook is still relatively bearish, and there are 3 key factors that continue to drive our position and sentiment in this market. The first one is that Chinese iron ore demand will continue to struggle and decline, mainly driven by the weakness in the steel-intensive construction sector. Secondly, the Chinese government and official policy is still to maintain caps on Chinese steel output, and that's becoming more frequent and also being more strictly enforced today. And thirdly, the increasing supply of iron ore, both from Australia and Brazil, but also we're seeing, of course, new supply being developed out of Africa. Guinea in particular is one I would call out. There are, of course, some balancing factors, some positive factors that could limit the downside risk for China. Firstly, of course, continued economic support from the Chinese government through stimulus measures. Secondly, rising steel demand elsewhere. Although China is weak, we're seeing strong demand, of course, and a very strong economy emerging out of places like India, which will help to counter some of this. And thirdly, we are living in a world of uncertainty driven by geopolitical tension. We're seeing conflict. All of these things could lead to logistical disruptions, trade bans, etc., which could, of course, be supportive to iron ore prices. Okay. Next, I talked right at the start about the impact that climate change is having. So let's focus a little bit on that topic and how climate change will impact, what the goals around climate change will impact market fundamentals. Well, first of all, of course, steel sector decarbonization is very front and center in terms of all discussions, and we're seeing this impact on the global iron ore market through opportunities that are emerging for participants. Firstly, we're seeing the shift in the product mix, which is fundamentally a shift towards DRI. And actually, if the industry wants to hit its goals by 2030, we will need to see a doubling in demand for DRI products, which means an additional 120 million tons per annum needed for the steel industry, which is in fact twice the existing demand levels. So that's a significant increase, and as a result, we're seeing investments in DRI beginning to pick up pace. But of course, we will still need a lot more capacity coming on stream if we are going to hit that 2030 goal. What we are seeing, we're seeing 20 million, for example, 20 million tons of DRI capacity, along with 41 million tons of EAF capacity being planned in Europe. Natural gas is the dominant energy source in terms of this production. What we're seeing, though, is, of course, that the plants and facilities being built have the ability to then convert that gas into hydrogen in the future as that becomes a more viable source. In fact, here in Asia, what we are seeing is steel makers going immediately into developing hydrogen-based solutions right from the outset. So what we're seeing, of course, is what this has is an impact on the demand, corresponding demand for high-quality iron ore lump and pellet. Although supply constraints here, of course, are going to lead to an impact on the market dynamics and pricing, and we're likely to see premiums going higher as a result. Especially as there is also a very scarce supply of DR-grade iron ore, it's going to be a major challenge to meet the demand that's needed for the decarbonization targets and goals. And of course, this creates the opportunities in the market. So let's just talk a little bit about iron ore trading. And of course, Will alluded to a lot of what's happening in the development of this market. We're seeing an evolution that has been taking place for more than 10 years, 15 years almost. And as I said earlier, in 2008, Fastmarkets, we were known at that point as Metal Bulletin, published its first 62% Fe fines index. This provided the transparency in a market which had otherwise been used to using annual contracts. And of course, in 2009, SGX launched its first clearing of an iron ore swap. In the following years, we continued to develop and evolve the market. We launched more prices, including the high-grade iron ore 65% fine, as well as the blast furnace pellet index. What we've seen is the evolution of the iron ore and steel trading has continued with new steel derivatives launched by the SGX, including a high-grade 65% Fe contract based on the Fastmarkets price. We've seen iron ore contract traded volumes, in fact, surpass 2 billion tons, showing a lot of liquidity in the market, helping drive further trading in iron ore. And a year ago, Fastmarkets also launched a new 67.5% Fe concentrate price, and in Jan 24, we added the magnetite premium to our iron ore price suite. So lots of options for the market that are being developed. And all of this is, of course, increasing transparency for the market. And again, that's what we hope to deliver through this conference, is more transparency on what's happening, the dynamics, the drivers. I hope that sort of set the scene for everyone as we move forward. But before I move on to introduce our first keynote speaker for the morning, I want to take a moment actually to pay a tribute to someone that the industry lost recently, Rod Duquino, who sadly passed away last week. Served 28 years with BHP, almost the same time that I've been here at Fastmarkets, and he made significant contributions to this industry. He started as an engineer, rose to the position of head of iron ore marketing, and in fact, over his time in managing that part of the business, I think responsible for shipping more than 1 billion tons of iron ore. So our thoughts are with Rod's friends, his colleagues, his family and loved ones, of course, as we mark and pay tribute for the remarkable contributions he made to this industry. So maybe just a round of applause for Rod would be appreciated. Thank you.